The data is in. CPI rose, which means inflation is on the rise. CPI came in hotter than expected, and while bears won the early trade, an overall green day in the Nasdaq goes to show that the conviction for the bears is simply not there. But as inflation ticks up, should we be concerned about a resurgence in inflation similar to the 1970s? Today, we discuss that and Apple. It is no longer the biggest stock in the world. As Microsoft takes the throne, we'll talk about what it means for your portfolio looking forward. Hello everybody, welcome to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit the notification bell, like this video. Let's get into it. It was quite the volatile day. The leaders today was software technology, semiconductors up there too, but mostly the big names. But the big story of today was Apple. It is no longer the biggest stock in the world. Microsoft has dethroned Apple. But other than that, a really shocking day in utilities. Very, very brutal. And here are the majors. TLT, RSPT, which is equal weight technology, and Nasdaq 100 performed the best. Everything else was red from the S&P 500, small caps, the market as a whole. Now looking at sectors, and software, semiconductors, technology were the best performing sectors. But what we did see around the 11:30, 12:30 mark was a strong rebound in almost every sector. And this was mostly due to options flow. For those of you that don't understand, where we are right now, week 2, week 3 of the month, Vanna and Charm flows are the absolute strongest. These are dealer hedging flows, and since we are in positive gamma, any selling, dealers do buy into it, and any buying, dealers sell into it, and it really does provide a supportive backdrop for the market as a whole. Now these will disappear after OPEX week, and this is when we can look for sell side opportunities to come in the market, and we will look at those later on in January. Now something else that flew completely under the radar today was on Wednesday, January 31st, we are getting the next QRA refunding announcement, the quarterly refunding, and we're going to see how many bonds, bills, and notes Yellen is going to push out to the public. Now looking at sentiment, the AA sentiment survey barely changed. We saw a small uptick in bears, but all in all, the volatility in the bulls and bears remains muted. But this number is still very, very elevated, so I think a lot of people are sitting on quite a lot of gains and continue to remain bullish. Now looking at NAM exposure, this is essentially how exposed active fund managers are to equities, and they're sitting at the 80 range, so that the rest of them are probably sitting on about 20% bonds or cash. Now let's look at CPI, guys. We really need to talk about this because it was the talk of the town. And you look at the figure as a whole, and it was hot. The headline was hot. I mean, we got 3.4% year over year. The consensus was 3.2, and we were at 3.1% in November. So quite the hot number. Core CPI, and this is excluding food and energy, and month over month came in line at 0.3%, and the same as in November. And then year over year was at 3.9%. Now we were expecting 3.8, and it is actually a decrease from November. So core CPI on a year over year basis is actually falling. It was just like the headline number that increased. So you have to have a look at the specifics right here. Okay, so this is core services, this is core goods, and there was quite a lot of deflation in core goods. You can see this right here, here. Core goods didn't increase on a month over month basis at all. Looking at services, which accounts for 90%, 85% of total inflation, shelter, the biggest component, which is 70% of core services, 0.5% increase month over month, and shelter consisted of OER, which was the biggest component, owner's equivalent rent, lodging away from home, and just rent in general. So shelter was a big component, and we also saw health insurance, medical services increase quite a bit. And I think this actually is going to continue, I mean, years down the track, especially with the aging population we're having right now. But everything came down to shelter, and it was the reason why this number on the surface came in hot. Now guys, the devil is in the details. On the surface, this number looks really hot, but if we dive deeper into how the Fed measure inflation and the components they use, this number is actually a lot cooler than most people think. The figure that the Fed uses to measure inflation for their CPI report lags by about 12 to 15 months. There are much better real-world indicators like the Zillow Index or the Apartment List National Rent Index, and this is actually the best figure to use because this accounts for actual rents, not just asking rents, and puts bigger weighting on that versus current rents. charts, and you could see that in December, this figure actually decreased as a whole. And if we swap out CPI shelter for ALNRI, we actually get a negative figure for headline and core. Instead of the 0.3% increase that we would have had a decrease of 0.4%. And what we're really waiting for right now is the Fed's metrics to catch up. So we're waiting for existing rents and new rents to catch up to the Fed's metrics. And when we get this, when they converge, which we do expect around spring, March, April, May area, that's when we're going to get a significant decrease in CPI. So all things considered, we could actually see more CPI increases in February and March, but we really should see that number decrease looking forward. If shelter does continue to increase past March, April, May, then it becomes a problem. But for now, it's not a problem at all. And how do we know it's not a problem? The market is telling us everything. This is Fed fund rate futures and the probability of a rate cut or a rate increase in March 2024. And let's blow this figure up and have a look right here, the target probability. So this is where we are right now. This is one rate cut, two rate cuts. So 25 basis point rate cut, 50 basis points worth of rate cuts. And just one day ago, 64% chance of a rate cut in March. Now we're sitting at 73.2%. And why is that? Because of what I just showed you. The market makers, the big boys, the big players, actual economists dove into the details like I did and looked at the actual shelter component and realized that, hey, a lot of this has to do with the lagging effects of the Fed's number. Shelter, CPI, core CPI was actually a lot cooler than we expected. And this is why rate cut probabilities increase, because there's still coolness in these CPI figures. If this wasn't the case, rate cut probabilities would have shifted from March to May, or this number right here would be less than this number right here. And bonds are literally saying the exact same thing. We had a great bond auction. If we wouldn't have had a good bond auction, if the market was really worried about the CPI figure. If inflation is increasing and you're buying a bond, you're literally decreasing your real return. And buyers and people wouldn't buy bonds. They'll probably go buy equities or just hold on to cash and collect a 4% yield, right? Why would they hold bonds? This is what the market is telling us. The Fed fund rate futures is telling us that the number is cool. The market is never wrong, guys. The FFR Fed fund rate futures is telling us that the number is cool, and so is the bond market. This is why we had a strong bond auction, and the 10-year yield, right, from peak to trough on the day was down nearly 2%. The bond auction was solid, and it wouldn't have been if inflation really was a problem. And if you dig into the stats, if it truly was a hot number, we would have had a terrible auction. Now let's look at the yield curve, guys. So the 10 to 2-year spread is sort of on its way to uninverting. We were moving away, in October, November, December, but this is starkly changing. And right here, this is when the yield curve uninverts. And normally a yield curve is a great indicator of a recession. Now let's assume this yield curve inversion brings on a recession. Here are the stats for when we can expect it to occur. And normally the first hike 27 months on, we get a recession. 9 months on after the last hike, and then the first cut 3 months on. And if we are expecting a recession, or if you are expecting a recession, the most likely outcome is around spring 2024. That's when you'll get your recession. Now let's switch gears, guys, and talk about generating alpha. So I went into my analytics and saw that a lot of you guys are over the age of 40. So I just thought I'd talk about the 60-40 portfolio, how it performed, and the expectations for it in the next 10 years. Now in 2023, the 60-40 had a real return of just under 10%, a nominal return of about 12%. So a pretty good year for 60-40, especially if you were in like the S&P 500 and a diversified portfolio of 5 to 7 year bonds, a couple of bills, and maybe a little bit of exposure on the long end, but not too much. And you would have seen returns very similar to this, where most of the alpha you would have generated would have been after October in 2023. Now, what returns can we expect in the future? And this is according to Goldman Sachs. If you look at DPS growth of 10% and inflation of 2%, you can expect a real return over the next 10 years every year of 4.6%. But if you forecast based on current valuations, you're looking at 0.8%. And here's the visual, right? So we have a dividend growth over the next 10 years of, let's say, 10% and a 2% inflation rate. This is how they get their 4.6%. But let's be more moderate. The S&P 500's dividend growth rate over the last 100 years is about between 8 to 10%. It really fluctuates per decade. Let's use 8% on the lighter end and use 2.5%, meet in the middle, and this would be right here. So you would expect a real return of a 60-40 portfolio of about 2.9%. And that's actually a really good real return if you do think about it, because it would be a nominal return of about 6 to 7%. But there are better ways to extract alpha. One of the ways is looking at something like Ray Dalio's all-weather portfolio allocation. It's very conservative and very defensive. It returned 9.95% in 2023, 7.33% compound annual return for the last 30 years. And it's very, very simple. You can buy it with just 6 ETFs, and it's VTI, TLT, IEF, DBC, and GLD in these allocations. And here are the stats. The total return for the last 153 years, you get an average annual return of 6.31%, right? And in an inflation adjusted return of 4.11. Looking at the 30-year, you'll generate 7.33% nominal, 4.7% inflation adjusted returns. That's a real return, right? Compared to the 2.9 in just your standard 60-40. So this right here, I think, is a far superior allocation to 60-40 because it does include a bit of gold and commodities. Let's talk about earnings, guys. Tomorrow, I've been hounding you guys about this. We have bank earnings tomorrow. Those are all the companies that are reporting. The earnings expectations for banks this quarter for financials is negative 3.1%, but we should slowly increase that to 24.2% quarter over quarter in 2024. And this is why if financials can hit these numbers and then maybe hit this, it's going to be a huge tailwind for 2024. And I think this should actually increase into 2025 because Yardeni Research, this is crazy, absolutely crazy. Huge bulls in the market right now. They have the SPX operating EPS for 2025 at 270 and 300, which means that the earnings forecast for 2026 is 300. Absolutely crazy. So they're expecting earnings growth of 10% this year, 11% next year, and then another 10% in 2026. Absolutely crazy. So now might actually be a really good time to get into stocks, especially if we're going to have 3 years of double-digit growth in the S&P 500. Now, looking at JP Morgan, one of the big financial names reporting tomorrow, we are expecting an expected move of about 2.7% up or down. And you can see that in the last 4 quarters, JP Morgan have beat all 4 times. And in the last 10 or 12 quarters, JP Morgan have only missed their earnings once. So what is the expectation? Probably they beat tomorrow. Jamie Dimon seems to be running that company very, very well. Now let's switch gears and talk about oil. I told you guys yesterday I have finally started building a position in energy. And here's a note from BOFA. Energy Information Administration disclosed an unexpected increase in crude oil inventories amounting to 1.34 million barrels. This rise was attributed to a decrease in exports and reduced processing. Additionally, for the first time in 3 weeks, there was an increase in stockpiles in the Gulf. This could be linked to refineries restocking inventories that had been reduced to dodge year-end taxes. Interesting. So this buildup was just to avoid taxes pretty much. The restocking activity had a positive impact on the physical prices of WTI for January, and this trend might persist in the upcoming weeks. So we could see a real uptick in oil prices. Now let's look at some more fundamentals, and I'm going to post a full breakdown of why I think energy is going to outperform this year. And I'm not comparing them to tech. I do think tech's going to outperform energy. I'm just saying I do think energy is going to do really, really well. Based on revenues, earnings, capex expenditure, and net profit margins, energy and tech are almost identical in all 4. The only difference between tech and energy is that energy is valued at a 9x PE, tech is valued at 32x. Very interesting stuff. When you actually look at the metrics, definitely see some deep value here compared to technology. Now let's talk seasonality, guys, and this is where we are right now. We're sitting right in line with what we normally would do in January. Although we have had major variation compared to the trend, we are in line as it stands right now. But let's talk about gamma really, really quickly. There isn't much to say besides the fact that we've had quite a lot of this gamma roll off, and puts are still not being bought. So there's still not a lot of fear in the market. 4800 continues to be our core gamma resistance, and that's probably going to be the strike we continue to move towards, especially towards the Jan OPEX. I don't think we're going to go significantly above. I think around 4800, maybe 4750 to 4800 is where we're going to end towards January OPEX. Now looking at the charts of the S&P 500, very interesting trade. We're still at this double top formation. I'm only bearish below the 47.05 area, but we will be looking for shorts towards the end of January, so keep an open mind to what's possibly coming. But all things considered, this is where we're just probably going to base up until January OPEX. I've said that so many times this video. So right before the open, I said SPX futures are ramping. I guess we just gap up to all-time highs and sell the 30-year auction CPI news. And that's actually exactly what we did. This is a 5-minute chart intraday. We opened, gapped up, sold on the news, and then bought the solid 30-year auction. Very interesting day of trade. Thought I'd put it out there. I actually don't day trade intraday, but I just called it completely perfectly. Now, I did put these trades out for you guys on the 2nd of January. I said these are stocks to buy and hold in 2024, and I just thought we'd have a look at these and see how they are performing for the year. Now, I don't own all of them. I own some of them, but let's have a look at them. Looking at AMD, it's forming this double top, but still very, very bullish. Down for the day, but up for the year so far. Looking at Celsius Holdings, it's about even for the year. We thought this was going to be the breakout, but so far this breakout, the strength is fading, but all in all, still quite bullish, all things considered. Looking at CrowdStrike, very strong. You don't want to fight this trend. Who knows where the top could be, but this is a bit of a concerning candle, but we normally get these every so often, and then the rally just continues. Now, looking at Alphabet, Google, again, another concerning candle, but we actually have made a higher high, higher low, and there's no reason to assume why this trend isn't going to continue. Looking at Nvidia, a technical breakout above this area. Again, another concerning candle. Maybe we pull back to 500 and then continue higher. I see a price target of like 650 for the end of the year for Nvidia. This is what the portfolio has returned all in all. 8.64% return year to date, beating the S&P 500. And Nvidia isn't even the best performing stock in this portfolio. It's actually CrowdStrike. So just something I thought I'd point out to you guys right there, that if you had bought this portfolio, equally weighted across all of them, you'd be up 8.64% for the year. Now, looking at data tomorrow, guys, we had CPI, we had jobless claims, we have PPI. Now, the difference here is CPI is what we pay for inflation. PPI is what corporations pay. So we've got PPI. I'm going to be very, very interested to see what it is tomorrow. And then we have consumer sentiment. But if you've made it up until here, guys, thank you so much. If you like this video, please subscribe, hit the like button, hit the notification bell, leave a comment. Cheers.